Reading financial statements is a crucial skill. Here's a step-by-step guide on how to approach reading financial statements. First step: understand the components of financial statements. 1. Balance sheet provides information about a company's assets, liabilities, and shareholders' equity at a specific point in time. 2. Income statement shows a company's revenues, expenses, and net income over a specific period, typically a year or a quarter. 3. Cash flow statement presents the inflows and outflows of cash from operating, investing, and financing activities during a specific period. 4. Statement of shareholders' equity, or statement of changes in equity, details the changes in shareholders' equity over a specific period, including dividends, stock issuances, and retained earnings. Second step: review the balance sheet. 1. Analyze the liquidity of the company by assessing the current assets, for example, cash, accounts receivable, and current liabilities, for example, accounts payable, short-term debt. 2. Examine the long-term assets, for example, property, plant, and equipment, and long-term liabilities, for example, long-term debt, to assess the company's solvency and financial stability. 3. Calculate key ratios like current ratio, current assets divided by current liabilities, and debt-to-equity ratio, total debt divided by shareholders' equity, to assess the company's financial health. Third step: analyze the income statement. 1. Review the revenue sources and the cost of goods sold, COGS, to understand the company's profitability and gross margin. 2. Assess operating expenses, for example, selling, general, and administrative expenses, and non-operating items, for example, interest income, tax expenses, to analyze the company's operating efficiency and profitability. 3. Calculate profitability ratios like gross margin, gross profit divided by revenue, and net profit margin, net income divided by revenue, to evaluate the company's profitability. Fourth step is examine the cash flow statement. 1. Analyze the cash flows from operating activities to assess the company's ability to generate cash from its core operations. 2. Review the cash flows from investing activities to understand the company's investment in assets or divestment of assets. 3. Assess the cash flows from financing activities to understand the company's sources of capital, including issuing debt or equity and dividend payments. 4. Calculate cash flow ratios like operating cash flow ratio, operating cash flow divided by current liabilities, to evaluate the company's liquidity and cash generation capability. Fifth step is consider financial statement footnotes and disclosures. 1. Pay attention to the footnotes accompanying the financial statements, as they provide additional information and explanations. 2. Review significant accounting policies, changes in accounting methods, and any potential contingencies or risks disclosed in the footnotes. Sixth step is compare financial statements over time and with industry peers. 1. Perform trend analysis by comparing financial statements from different periods to identify patterns and assess the company's performance and growth trajectory. 2. Conduct benchmarking analysis by comparing the company's financial ratios and performance indicators with industry peers to evaluate its relative position. Seventh step is look beyond the numbers. 1. Consider qualitative factors such as industry trends, competitive landscape, regulatory environment, and management's commentary to gain a comprehensive understanding of the company's financial position and performance. Thank you for watching video. Please like and subscribe for more videos from me.